Hey, good morning. This is Skyler with Regan. Just a quick update on what we're looking at here in terms of the bond market and what's happened over the last week. So, what I look at first really is week over week move in the treasury market. So, we have the yellow line here, which was last Monday's treasury curve. The green line is today's curve. You can see the movement here. We're only about 24 basis points lower kind of in the 2 to 3 year part of the curve. But in the quote unquote safe haven, 10-year bonds are only down about 15 bips. 30-year bonds are only down about five. We can see that table here. Okay. Just in terms of numbers. Now, let's look at a couple of different charts. So, what I did here is I pulled up, and this is live. We pull up, you know, last Monday, Tuesday, Wednesday. Okay. Equities were actually up into the tariff announcement, which took place at 4 p.m. last Wednesday. And then we have Thursday, Friday. And we had a huge gap down, 56.70. Right now, we're at about 4,900. This chart hasn't updated, but you can see here we're down another 100 points or so since this point. So I'm going to focus really on this point right here, kind of after the news took place. Okay, early morning Tuesday or early morning Thursday, April 3rd. So equity markets are down five. They were down another 5 to 6. Right now, they're down another 4 points or so. So call it 12 to 13 points in total. But relative to, let's look at 10-year bonds. Okay. So I'm going to look at that same time series basically over the last 5 days, 5 business days. And this includes where we are right now. So I actually got to start March 31st. So Monday, Tuesday, Wednesday, Thursday, Friday. Here's where we are today. Okay. So this is pre-tariff. This is post-tariff. Okay. So you had that little move here, went up to about 104 and a half. And here we are right now. Generally speaking, the market really hasn't moved very much. It's moved a little bit, and we'll get to the data here in a second. But I just wanted to point out, there was a sell-off, but now we look at bonds having almost exhausted their rally. So when we look at the data, okay, this is from 3, 4 minutes ago. Okay, so here's where we were pre-tariff. Here's where we are today. Here's the move. So you have twos and threes dropping 24 basis points, but the long end barely dropping at all. That's 30-year bonds. Here's your percentage move. So what we're doing here is we're taking this move and multiplying it times our duration. But on a duration adjusted basis, really only this portion of the curve moved very much. Okay, so I'm taking the move and dividing it by duration. Okay, so most of the move has happened in the front end of the curve. Why is that? Well, a lot of that just has to do with Fed predictions. We went from being the market implying, call it, and let's look at up to the minute, where end of the year we're looking at we're at 323. That's about 4 Fed cuts priced in this year, with another Fed cut priced in for next May. Where were we on the 31st? That was 323. This is about three. So you're looking at an extra 1.5 Fed cuts or so. Okay. And two less Fed cuts in terms of terminal rate. So it's a couple more Fed cuts that are priced in that are leading to this rally in the 2 to 3 year part of the curve. And if we think about, how should we be positioning going forward, let's bring up to the minute data. Okay. So we have the current yield, where yields are supposed to be in a year from now. And this is what your projected total returns are. On the front end, the belly, and long duration. You could see the belly here, 5 to 7 year paper offers the least amount of expected total return. There's still a ton of value here. And let's go back to the curve that we're seeing right now. And I'm going to contrast this to the month that the Fed cut interest rates last year, September 1st. Okay. So you're actually seeing higher terminal rates, higher long term rates today than what we had back then. Obviously, much lower front end rates as the Fed's cut about 100 basis points. But what I really view is what can I get on cash for 30? How long do I have to go out to get 4.3? It's about right here. You have to go out about 15 years to get that. So, moral of the story in what we've seen over the last week is you're still getting paid to stay short. Okay. What's moved the most on a duration adjusted basis have been short duration bonds. Okay. And why is that? Well, the long end of the curve is primarily driven by inflation expectations and supply and demand. Okay. I think the market can coalesce around, hey, what's going on right now might cause higher prices. And what may happen, whether if unemployment goes up or if the Fed gets worried, what they may do is they may be forced to cut 50 to 100 basis points this year. So stay short. Stay in the part of the curve that's going to move the most and isn't driven by supply, demand, and long term inflation expectations. So we continue to stay short. We continue to look at this part of the curve as offering the most amount of value. Okay. And I'll touch briefly on spreads. So let's look at what's moved a lot. This is high yield CDX, currently 24 basis points higher today. This is, we're at about 465. Okay. And a lot of news came out this weekend. We're not still at crisis levels. Okay. Crisis levels on high yield. High yield can get out to 1,000, 1,200 basis points. Today it's at 463. Only a year and a half ago, we were at 515. This is 2022. We were at 620. COVID, we got out to 650. I think we get out to 1,000 real briefly. So we could see high yield spreads gap out another 100 basis points if what we're seeing today persists. Let's look at investment grade. That's a huge move in investment grade spreads from 45 up to 77 real quick. Let's look at the 5 year. We're also approaching, kind of that territory where investment grade spreads might get out to 90 to 100. Let's look at agency spreads. This is agency MBS. Current coupon spreads are at about 150. If I zoom out, maybe they get up, worst ever was about 195. Maybe they go out another 5 to 10 basis points. But when we think about the dynamics of corporate credit versus agency mortgage credit, okay, who's going to be most affected by tariffs? It's going to be corporate companies that where tariffs are actually being applied to versus mortgage backs. Okay. So mortgage backs, you're looking at US residential housing. Now, housing may be affected. We've seen home builders kind of get affected over the last couple of days. That's future homes. Okay? But the homes that are in place, people that have mortgages in place with government guaranteed credit, we don't see them being affected nearly as much as corporate credit will. Add on to that, okay, if mortgage rates actually do fall, if the 10-year falls 25, 30 basis points, it's already fallen, 23 or so. If it continues to fall, we're going to see a refinancing wave. There's going to be people that pull out that lost money in the stock market. They're going to gain equity in their home. So when we look at the agency mortgage market and the mortgage market as a whole, almost everything this is the bulk of mortgages outstanding, two and a halves, threes. The bulk of mortgages outstanding, where are they trading? They're trading under par. Okay. So investors really want those mortgages to actually refinance. And so, newer issue coupons trading at or above par, beware there for negative convexity. But there might be tremendous upside for discount mortgage backed securities. This is Skyler with Regan. Thanks for your time.